Hey, Bowtie Nation, Joseph Hogue here. It's so good to be live with you. Thank you for joining us for another live stream. Been a long time, so a couple minutes early, but I was so excited. Had to start this off. A big topic for you today on the inflation news and what it means for the market going forward, even into the next few years. Going to get to that. I'm going to get to Q&A. Haven't been on live for a while, so love doing these live streams. A little bit closer connection with all you out there in the market. A big surprise was on inflation Wednesday with that CPI report coming in lower than expected. The core 4.8% year over year was a little bit high still for the Fed's taste, but I'm going to show you why. That might be wrong, might be a little bit higher than inflation actually is. Going to show you another measure that shows inflation might actually be almost to the Fed's target right now. What that's going to mean for interest rates. I'm going to show you that inflation might already be beaten on that measure. It's not going to stop the Fed from raising rates one more time here in July. They got to keep that credibility that they are fighting inflation no matter what. So they're going to raise rates one more time here in July towards the end of the month. But that's going to be it. And that is going to signal that the market is ready for a new bull market. I know we've already been up, 16, 17% so far this year into that new bull market off of October's lows. But this is going to be a multi-year bull market. And even if the economy slows down, we are expecting second quarter earnings start coming out this Friday, and through the next couple of weeks, we are expecting very weak earnings from corporations. In fact, down 7% on average for S&P 500 companies. They could even warn on the fourth quarter that the economy is weakening even further, but I'm going to show you why that might not even matter for the bull market, because we have all this room for the Fed to eventually lower interest rates and support the economy. Why they're going to be able to do that even in the face of some of the inflation reports that we are getting. Then I'm going to show you and reveal the 10 stocks I'm buying right now for that new bull market. We're going to get into question and answer. And gonna have a lot of fun. So I want to get to it here, get into our topic though, because Wednesday's CPI report, the Consumer Price Index, was lower than expected. The headline number was just under 3% year-over-year inflation, which is great. Obviously, what we want to look at is the core measure. That core measure strips out some of those month-to-month volatility things like food, like gasoline costs that tend to go up and down so much each month that they really don't give you a good report of ongoing inflation. That was a little bit higher. That was 4.8% on that core measure. I'm going to show you why that might be artificially high here in a little bit, and while the actual inflation year over year for consumers might actually be down closer to about 2% or 2.2%, which would be actually the Fed's target. I do want to address a couple of the chat's comments here. Diane asks, are those monthly fees? No, that is, you are purchasing an actual investment, a percentage share into perpetuity of the channel, okay? So if we go back here, I want to get back to our topic, but if we go back here, if you buy a gold token for $31, that is it. You own that gold token into perpetuity in a year, then you'll have the ability to buy or sell those. As an investment. We're going to have a secondary exchange there on GigaStar Market, just like a stock market there. You're going to be able to sell your tokens if you like. You're going to be able to hold on to them or buy more, but that is a one-time thing, $31, and you're going to get that 0.0039% of the total revenue generated on the channel. How that's going to work is each month I set up an LLC that each month all the revenue generated from Let's Talk Money, the ad revenue from YouTube, goes into that account. That business then separates by percentages out to the investors. So right now it's about 17% of the channel revenue going out to investors each month. They'll take that, they'll distribute it to all you investors. You'll get that paid out in each month in USDC, which can immediately be converted into dollars and deposited into your bank account. So it's going to be generate monthly income for you that you can spend immediately. It's a one-time thing. So you're going to be able to do that. Get back to that inflation measure though. So that was Monday's, and now that is not the measure that the Fed uses as interest rates. We're going to talk about that here now. The PCE, that's the personal consumption expenditures report, comes out later in the month. It's another inflation report that the Fed really watches closer for inflation, but that also was lower than expected last month. And now what I want to show you is some really interesting data from Wall Street Journal here, talking about the difference in how the U.S. measures inflation through that CPI CPI, the CPI report that came out Wednesday that was lower than expected, but still a little bit high at 4.8%. The Fed's target, the Fed says that it wants to get inflation down to 2%, before it really starts, cutting rates or anything like that. So it's going to hold rates higher until inflation is measurably closer to that 2%. Well, obviously 4.8% on the core inflation isn't going to do it. So to get down to that point where we can start cutting rates and really, boosting stocks and supporting the economy, we need to get that core number down. But what I'm looking at here is and what you see in this light blue measure here, and I'll increase this a little bit so you can see this chart here. Now, this light blue measure that says 2.27% for core HICP here in June versus the core CPI, which was 4.8%, right? Now, that the way they measure in Europe, inflation, it's called Harmonized Index of Consumer Prices. And the big difference here is the difference between the CPI here in the United States measures owner's equivalent rent, right? It's kind of a fudged number. It's a survey number. It's not even a real measured rate of inflation. They basically just ask tenants, they ask landowners, they ask landlords, how much their rent has increased over the past year. So it's more of a survey, not really even a measured inflation measure. And that is what is keeping that core CPI number up at 4.8%. Stripping that out and using only actually measured rates of inflation, the core CPI would be closer to 2.27%. Okay, so yes, there is a lot of problems. We even see in the comments, Miss Locum says, I hate the way that the data is collected. There is a lot of problems with how they collect the CPI and, how it lags. That rent measure, that owner's equivalent rent measure lags by up to a year, so we have seen it start coming down quite a bit to those rent costs and things like that. So that is bringing that core CPI down, but it is still artificially high and, probably higher than it actually is. So if we're looking at this core HICP measure of inflation, 2.3%, that is very close to what the Fed is looking for in their, in their inflation or in their inflation target. Now, what this means and why this feeds into why I think this bull market is here to stay, it's going to come back even if the economy weakens, which we are still expecting the economy to weaken further into the third and even fourth quarter. And we're going to hear about that from companies pretty soon here this week and over the next couple of weeks in their earnings. But what this means is that the Fed is done raising interest rates after this year. We're here on the CME Group's Fed Watch tool, great little tool to show kind of market-based odds. They use probabilities of changes in the Fed rate from the 30 days Fed funds futures pricing data. Okay, so futures pricing data on the Fed funds rate, they use that to kind of predict what the market is expecting as far as Fed rate hikes. We got another Fed meeting here in 13 days on the 26th of July. And you can see here that there's 92% chance that the Fed will raise rates by 25 basis points, by 0.25% here on the 26th of July. That's pretty much set in stone. The Fed has said that even though they paused last month, they will likely be raising interest rates here just to make sure that they are able to bring inflation down, right? It's a lot of this goes into their credibility as, really trying to bring inflation down. If they're seen as weak against inflation, then obviously that boosts those expectations of inflation, and it could get out of hand. So they are going to raise rates one more time to a top point of 5.5% on the Fed funds rate here in July. But if you look at the odds now in these, you can look through the different months, September, November, December. You see the odds are all stuck at this 525 to 550 on the Fed funds rate. So the market is now expecting no change throughout the rest of this year. Even into December, you got 65% chance. Fed funds rate is still at 525 to 550. You get into early next year though, and that's when the changes start happening. Okay, January, the expectations right now for rates to 37% chance that rates are still at 525 to 550, right? 5.5% on the Fed funds rate, and 50 55% chance that the Fed has lowered rates at least at least 1/4% by then or at that meeting. You get into March and the odds are even greater that the Fed has, basically about 85% odds that the Fed has lowered rates at least 1/4% or 1/4 point by March meeting. Okay, now, so this is so important because we know that the big impetus to the stock market sell-off last year was that increase in rates. The Fed increased interest rates for the fastest pace in 40 years, okay? And I know, all this economic talk, it might not seem important, but that is a cost of doing business. That is hugely important for real estate because, those higher interest rates, real estate is very much over-leveraged and falls on those interest rates. Anyone applying for a mortgage knows that those interest rates going up is affecting how much you can buy as far as a house. So that fastest interest rate increase in 40 years has really hit stocks, has really started to affect the economy. And I think we're going to start seeing that even more here in the third quarter. Now, the economy is, as we said, the economy is expected to continue to weaken from those interest rate hikes. See here, the Fed FactSet earnings insight. Okay, free resource, great resource. For following what companies are expected to report as far as profits, that kind of thing. Here we do see that the second quarter earnings expected to start coming out right now. Banks are going to start us off tomorrow. We're going to get over the next few weeks. Companies are going to report their earnings for the second 3 months of the year. So April, May, and June, expected to be down 7% from the year before. Revenue down 0.3%. So earnings and sales expected to be lower from last year. That would be three straight quarters of lower interest rates, right? So obviously, corporate profits are slowing down. We are expecting here in the third quarter for earnings to be up just 0.3% for the year-over-year basis. I do expect when companies start coming out with their earnings over the next couple of weeks, they're going to guide lower. Okay, they're going to play that game. They're going to manage those expectations to say, hey, the economy is still slowing down. We're worried about third quarter earnings. We want to see how it goes, but we're going to warn a little bit lower. And those expectations for earnings are going to come down probably into negative territory again, for the third quarter. Obviously, companies always beat their expectations. That's just the little game they play with investors and with analysts. But it is obvious that the economy is still slowing down a little bit. Now, why that doesn't matter, though, because I believe, with this inflation data, with this confirmation that inflation is coming down, and in fact, using that, stripping out the fudgy kind of, owner's equivalent rent measures of inflation, it is already very close to where the Fed wants it to be. Then I believe we're coming into kind of a Goldilocks scenario for stocks. Okay, the inflation this low, even if the economy does fall a little bit, the Fed is going to be able to cut interest rates and maybe even faster or earlier than the market is now expecting. Okay, again, market isn't expecting the Fed to be able to cut interest rates until probably January or March. I think if we do continue to see weakened economic growth and we see that those inflation numbers keep coming down, Fed might still be able to cut interest rates by December or even November to really support the economy. Obviously, the fastest pace of interest rate hikes in the last 40 years. We've got a lot of room to cut. Okay, Fed, as of when they meet here in July 26th, they're going to raise the Fed funds rate up to a target range as high as 5.5% from zero. Just after the pandemic. Obviously, we're not going to get back down to zero. There is no reason why interest rates need to be at zero, especially with the jobs market so strong as it is and consumer spending still strong. But even if the economy does continue to weaken, then that is still 2 or 3% of interest rates that the Fed could cut. And that is going to be a big move for the stock market. It's really going to support stocks. So I think good as long as good economic data and profits keep coming out, then obviously that's good for the stock market. Even if they don't come out like that, though, then that weakness in the economy, that's still going to be okay for the stock market because, it's really inflation. It's about inflation right now. How much can the Fed, or how early can the Fed start cutting interest rates to really support the economy? And obviously, that would turn around the last year of pain in the markets, and the 2022 pain with those interest rate increases. That would reverse a lot of that. And I want to show you the stocks that I think would benefit most from that. Okay. So again, what I'm looking at here is the stocks and the investments that were hit hardest by those increases in interest rates. Okay, those are, I think, as we get this changing regime in interest rates, right? As the inflation number comes down and we start seeing that pretty soon those interest rates can start coming down, I think you're going to see the turnaround in a lot of these stocks and investments as, just the reverse from what we saw last year. So I want to start off first here is going to be the growth stocks. Obviously those growth stocks, the interest rate hikes last year really hit a lot of those growth stocks, because obviously, so what you got to understand with stock valuation, one of the biggest tools for stock valuation is called the discounted cash flows approach, right? So as an owner of a company, as a stockholder, you own the future cash flows from that company. Okay. Well, you've got companies like Coca-Cola and Pepsi and General Electric that have very strong cash flows right now. In the future, probably stable or flat cash flows, nothing to get excited about in the very distant future. But right now they're pretty good cash flows. Okay. So all those companies, when you take all those future cash flows, add them up, discount them for that future value by interest rates, you divide by the interest rates and how many years into the future those are, then that is still a very high number, right? Because it's very much current cash flows. You take these growth stocks like SoFi, like Rivian, like some of the other growth stocks that I'm going to show you and I'm going to talk about right now. You take those cash flows are way out into the future, right? SoFi is still negative, still unprofitable company, expected to turn profitable here in the fourth quarter and into next year, but still negative cash flows, for the next quarter. So if you discount those cash flows that are so far out in the future, you discount them by those higher interest rates, it's obviously got to be a lower stock valuation. And that's what happened to a lot of these growth stocks here in 2022. When those interest rates started going up, that present value of all those future cash flows came down by, just a historic amount. We started to see that unravel or reverse earlier this year as we started getting closer to the end of the interest rate hikes and eventual cuts. But I think we're really going to see that here over the next year. Now, what I'm thinking, though, obviously a lot of these growth stocks have already come up quite a bit, so maybe you don't want to go all in on them all at once. You want to save some money back a little bit for lower prices. But what you got to understand here, these growth stocks, you got to take a long-term view on these, because into that next bull market over the next 2, 3, 5 years, these stocks are really going to prove, that growth picture. And I want to show you a couple of these. I want to show you why. SoFi, obviously, one of my favorite stocks. It's up about 86%, 96% or so just in the last couple of months as the student loan issue becomes resolved. They are one of the few banks to actually increase deposits in the first quarter. Got a couple of charts here for SoFi. SoFi actually reported 43% year-over-year growth in revenue. Okay, for a bank, 43% revenue growth in year-over-year is huge. And again, was one of the few banks in the first quarter to actually add deposits. They didn't see the big fallout, the big crisis that a lot of the regional banks were seeing. They actually added almost 500,000, almost 500,000 users in the first quarter alone to 5.6 million users there in the first quarter. And despite all this growth that we've seen from SoFi, it is still just a minuscule bank, right? Just a $10 billion bank with a lot of room to run. Okay, $10 billion deposits. So that puts them very, very low even in regional banks. But, they're soon going to be adding back in that student loan payments back into revenue. and this bank is going to be a major bank here in the future. Obviously, again, it has increased quite a bit. I think it got downgraded just today. That's why it's down 1.4% today. Got downgraded just on valuation. Obviously, if we look at the statistics now for banks, you got to use that price to book value, okay? Because banks hold their deposits and their loans on their balance sheet, at close to fair value, close to current value. Then you can look at a bank's book value as a true measure of the assets and liabilities on that. Now, right now, SoFi, when we first started talking about SoFi last year, it was trading close to 0.7, 0.8 times on a price to book value, which for a bank growing its revenues by 40% a year is just obscene. Okay, that's why I've been investing over the last year, up about 65% from my cost basis on shares of SoFi. But now it is trading for 1.6 times on a price to book value. That is very high for a bank. Most banks, I think the average for banks trade for about 1.2 times price to book. For a bank growing as fast as SoFi, I would be comfortable with 1.4 times price to book. So it is a little pricier, but again, remember, this is going to grow into that valuation over the next 3 to 5 years easily, and could still be a very good money or a very good return on your money for that kind of into this bull market. Rivian, another one that has just taken off recently. You see here, this is just in the last month, just since June 26th, it was at just $13. Now it's at $25, coming back a little bit again today, just on that valuation again, but almost doubled just in the last month on this stock. What happened here was it surprised on its Q1 production. Okay. Rivian, I thought I had it here. Rivian surprised on its Q1 production. It is easily going to hit its 50,000 production target for this year. It's actually probably going to be closer to about 60,000. If you remember back in February, they surprised negatively on production. They lowered market's expectations for only about 50,000 units produced here in 2023. That would still be double what they produced last year. But at the time, the market was expecting about 63,000 production for this year. Rivian management came out and played the game. They came out and said, hey, we're worried about the price wars that Tesla is starting in EV. We're going to lower expectations for just 50,000 units produced this year. And then internally, they went through in an internal memo and told their staff that 60,000 was the real target, that 60,000 was possible for production. So obviously that's probably a little bit closer to what they're actually getting. They were just trying to play it safe and eventually beat that production target numbers when all is said and done. Obviously here with the Q1 production surprising on the upside, everybody sees that Rivian is an EV company that can compete and even just a fraction of the EV market. Okay, EV sales right now in the U.S. are about 7.5-8% of total auto sales. That is expected to boom to as high as like 35-40% here by 2030. That would be that would be upwards of 6 or 7 million more EV cars sold each year. Just a fraction of that is going to make Rivian a very good return. Okay, what I'm most excited about and what I'm watching in these next couple of quarters for Rivian is their profitability. Okay, the big hurdle for a lot of these newer EV stocks, Rivian, Rivian, Lucid, a lot of the newer ones, is their cost of production per vehicle is still very high. They cannot compete against Tesla, against NIO, against some of the older EV car companies on those prices because it still costs Rivian something like $110,000 for every electric vehicle it produces, whereas Tesla has already gotten its production down to about 30 or 40,000. But Rivian at 60,000 units produced this year, expected to be produced this year, is right around where Tesla was a few years ago when it really started to see those production costs come down. Okay, you get to those economies of scale where it can really bring down those per unit production costs and really start ramping up profitability. I think that's where Rivian is right now. I think that's where the market sees it. It sees the production ramping up. That's why the shares have doubled here over the last month. And even on this price, though, obviously with all these growth stocks and that huge, that doubling in the share price, it's getting a little bit more expensive, obviously, than it was just a month ago. more expensive than when we talked about it a few months ago back in March. I highlighted it and bought shares myself, but even a fraction of that EV market over the next 5 and 10 years, it's still going to be a 5 or 10x stock. Okay. Next, DraftKings. And what I'm looking for here, folks, is, these growth stocks, like I said, they have boomed higher just this year, some of them doubling in price just over the last month or so. So they are getting expensive. But what I'm looking at is companies that are changing their industry. Okay, SoFi is changing online banking, changing traditional finance. Rivian and Tesla are changing vehicle production, right? Changing, reinventing into that electric vehicle approach. DraftKings here is changing the way people bet, okay? DraftKings is still only in 17 states for about 36% of the population. I've got here's the chart here. Online sports betting is legal for about 44% of the population. It's legal in about 23 states. DraftKings is in 17 of those, so it's still got some room to expand just in the states where it's already legal. But it's still a very big market for to increase. To move into, the 27 states that where it is not, or the 27 states where it is not yet legal to place a bet online for sports betting. Okay, that is still a very big market that DraftKings can tap. And what I love about this company is when it does go into a market, it takes 20 to 30% market share of that. DraftKings is the largest online sports bettor next to FanDuel. Okay, FanDuel is a little bit larger market share, higher market share, but DraftKings gets 20 to 30% of the market share for every market it goes into. So if you consider right now, it's in just 17 states, about a third of the U.S. population. Eventually, when that entire U.S. population opens up to online sports betting, they predict that is a total addressable market. That is a total market of about $74 billion when you include that iGaming component. If you look at 20, 25, 30% market share on those, that is, and they're not even estimating full U.S. population penetration there. They're only saying about 65% U.S. population with legalized OSB, 30% legalized iGaming. So the actual eventual mature market numbers could be even higher than this. But this is upwards of, once they're in that, this is upwards of $8 billion revenue just for DraftKings versus $2.2 billion reported last year. So 4x times their revenue. What I also like about DraftKings, if you look into this report they put out, the investor presentation, they're also getting more out of each bettor. Okay, they have increased their revenue per player from $67 last year to $92 this year. Okay, so they are not only getting into more states, increasing the number of bettors on the app, but they're getting more out of those, right? So that $8 billion is going to be leveraged up into even higher earnings. And it's going to mean, again, this is going to be a very strong stock over the next, over the next several years. And of course, Tesla. You can't ignore Tesla as a growth stock. I am nowhere near the estimate for ARK. ARK Invest still thinks that Tesla can reach $2,000 a share by 2027. That's a little ridiculous. And frankly, I would have a hard time looking at myself in the mirror if I was predicting $2,000. So almost a 10x here in the next 4 years. But it is undeniable that Tesla is dominating that EV market. They control right around 50-60% of the EV market right now. That is expected to come down to about 16% by 2030 as the other EV car makers come into their own. But that is still going to be a very large market share of a market that is growing by double digits a year. Again, electric vehicles still only about 8% of total vehicle sales, expected to reach about 30-40% at least by 2040. So Tesla is going to continue that market. So clear leadership there, and robotaxi growth is really where ARK Invest says the next big profit driver is for Tesla. Okay, so obviously Tesla is going to make money on those EV cars. That's, I think, pretty much already priced into the stock here. If you look at the valuation on Tesla, it's already pricing in a lot of that upside from the EV revolution. What it's not pricing in is the robotaxi growth, and that's what ARK Invest says it's going to 2,000 by 2027. I'm not quite sure about that price estimate, but even if it just captures, and again, just a fraction of the robotaxi income here over the next 5-10 years, that's going to take the stock higher. If you can look at some of these estimates. If you just type in Google ARK Invest Tesla price target, you're going to find this page with their analysis and their research, and it shows revenue by business line expected to be total revenue for Tesla expected to be about $1 trillion, $1,020 billion by 2027. If you look here, 44% of that is expected from robotaxi, just 47% from electric vehicles. The enterprise value, so the company value, basically kind of stock value for the company, is expected to be $6 trillion. That's where they're getting that $2,000 price estimate per share. $6.1 trillion enterprise value by 2027, and 67% of that enterprise value is from robotaxi. Okay, so that's where they're getting that huge price target for Tesla. I'm not so sure that, because, robotaxi is self-driving. It's something that we've been promised for years now. Never seems to work out. Obviously, it is coming, but it's constantly being pushed back. And I think it's probably going to be pushed back a little bit further than what ARK Invest is predicting or forecasting here. I don't think by 2027, 67% of Tesla's market cap or enterprise value is going to be from robotaxi. I think it's going to be lower than that. Obviously, Tesla shares are going to be much higher, but not quite to 2,000. But it's still it's one of those stocks that, even though it's risen so far this year, it is still dominating its market. It is still changing the way we work in an industry. With electric vehicles, with DraftKings, with sports betting, with SoFi, with financials. These growth stocks, they are expensive, but 3 to 5 years down the road, you are still going to make a very good return in this kind of bull market scenario where the Fed can start cutting rates and supporting the economy and supporting stocks. And again, these growth stocks were hit so hard with those higher interest rates. Once we do get some kind of idea that interest rates are going to be cut, then those are going to come down. Another two stocks and another really theme that I want to talk about here for that idea of falling interest rates eventually is real estate. Okay, real estate was probably the biggest loser with those increasing interest rates. Obviously, real estate is very highly leveraged. What I'm looking at here, I'm going to show you. You go to if you just go to Google and you type in NAREIT, so that's NAREIT. Property sector returns. Okay, NAREIT is the National Association of REITs, National Association of Real Estate Investment Trusts. Property sector returns. You're going to go there. You're going to see this performance by property sector subsector. You click on there, and you can download it in Excel or PDF document. And this is what it looks like. It's a great resource. You're investing in real estate, or you're looking at some of these REITs to see the property types, how they did last year, and then the year-to-date performance. So here we have 2022 real estate investment trust down 25%. It was the worst performing sector last year because of those interest rate hikes. Okay, again, real estate is extremely leveraged. So anytime, so obviously, that means interest rates. And on those loans, the leveraged loans. So anytime interest rates go up, property values come down. Also, though, for a lot of these property types, they pay, commercial property owners a lot of times will pay interest only, on their loans, and then just refinance when those loans come due, 3, 5, 10 years, whenever they come due, or they'll have variable rate loans. So anytime interest rates go up, and especially if they go up as fast as they did last year. Okay, again, Fed raised rates fastest pace in 40 years last year. That hit the property market because a lot of these properties now became unprofitable on those variable rate loans. Those variable rate loans turned over. They had to refinance those at very much higher rates, and the income from the property just wasn't enough to cover the new interest payments on those loans. So again, 25% down on real estate last year. This year, it's not doing that great. 3% up, only 3% against a market that's up about 20% year to date for the stock market. So if you look through some of these here, you get a sense of, okay, which has been hit harder and which might come up. Okay, I do believe, as we get closer to cuts in interest rates, obviously, again, real estate very much heavily leveraged. Those interest rates coming down are going to be a boom to real estate. It's going to bring out the bargain hunters. Property prices are going to go back up, and you're going to see these real estate investment trusts rebound very fast. Remember, real estate was the best asset, the best performing asset over stocks, over bonds, over everything for 5 of the 6 years after the great financial crisis in 2008, right? It had a huge sell-off in real estate for those couple of years there. And 5 of the 6 years after that, real estate outperformed. And I think we're going to get another couple of years where real estate is probably one of the best performers here as interest rates start coming down and as the bargain hunters come out for these real estate stocks that were down 25% last year. So you come through here a little bit. Office down 16% this year, down 37% last year. So probably the worst performing property type, those office REITs. I still would be worried a little bit about these, mostly because, it is very expensive to change those office property types into something else, into residential. They're talking about changing a lot of office, city office property into residential. Well, the problem with that is people aren't living in the cities as much as they used to. If they can live anywhere and just commute to work or telecommute to work or work from home, they're living in the suburbs. So even if you do convert a lot of that downtown office space into apartments, there's not going to be the demand for it. But it is also very very expensive. Okay, the office property isn't set up to code for apartment living. So that is very expensive to convert. And it just isn't going to happen as quick as I think a lot of people are. So I'm not quite ready to jump into office space. There are some deals there, though, or those office REITs. Retail, obviously, long-term downtrend versus versus e-commerce and things like that. What I'm really looking at, though, is some of these others. Lodging and resorts. So hotels have seen a big sell-off. They sold off 15% last year, only up about 4.5% this year. But these hotels, the problem with this is it is all rate-driven weakness. Okay, there is still fairly strong demand for travel, lodging, resorts, hotels, things like that. Okay, we just got good news out of, I think it was Delta, one of the airliners this morning reported their earnings. Very positive earnings, airline demand, travel demand. That obviously means that lodging and resorts are probably going to benefit from some of that demand. So we're still seeing very strong demand for lodging and resorts and hotels. But these stocks have been hit by that rate-driven weakness. Okay. Rates are hitting prices, with the interest rates increasing, obviously those property prices come down, but also, again, a lot of these are variable rate loans that are resetting and hitting the cash flow with those businesses, okay? So a lot of these hotels, a lot of the large hotel owners just letting a lot of those properties go back to the bank, because on those new higher interest rate loans, then the cash flow from the property doesn't even cover the interest. So they're letting those go back. A lot of pain there. So I would be looking at those lodging or resort properties. Going to be looking at a couple of those and show you how to find those here in a little bit. Healthcare also. Healthcare down 22% last year, up 7.8% this year. So doing fairly well this year on that rebound. And I think that continues to rebound. Obviously, healthcare has a very strong long-term demand characteristics to it. We are only using more medical services. I would watch out for those healthcare office spaces. So anytime you look at a REIT, you want to know with what property type it invests in, what region of the country it invests in, as well as maybe subsectors of that property type. Okay, so for healthcare REITs, you want to see if it's is it all assisted living? Is it all office space? Is it all facilities like hospitals and things like that? Okay, I would stay away from the REITs that are largely healthcare office space. Okay, I would stay mostly in the healthcare companies that own mostly like facilities, hospitals, clinics, things like that, because obviously that's where the demand is, and I think that's where the upside is for a lot of these healthcare companies. We saw the reimbursement, government reimbursement for healthcare services just did not keep up post-pandemic. Okay. So a lot of these facilities, the hospitals, the clinics, they had a hard time paying for those loans. That's what we saw with MPW, Medical Properties West. A lot of their tenants, really had a hard time paying those property costs. paying the leases on those property costs because those reimbursement rates weren't keeping up. We're starting to see that turn. A lot of the healthcare facilities, stocks and the companies are reporting better fundamentals for this year, better revenues, better earnings. That's going to flow through to these healthcare names. Now I want to show you. So that's how you get kind of the big picture of these property types. If you're looking at REITs, real estate, and I think you should be, obviously, with those with those interest rates coming down pretty soon here, early next year or late this year, you're going to see this real estate really take off. That's how you get the big picture for which property types and which REITs you might want to invest in. Then you're going to go to, and if you go to NAREIT, if you go to REIT data, go down here to REIT market data in the menu, and you can come down here to REIT Watch. Okay, REIT Watch, you click on there. It's a month by month, data on the entire REIT industry. It's a great, huge data resource. I opened it. We're going to open it here. There we go. Okay, so this is a huge monthly data that they give you. You can look through this, a lot of charts, a lot of stuff. What I always liked going is down here to, starts on about page 39 or so. This is going to show you, all the each property type. So we start here with office. Each real estate investment trust. So each real estate stock in that property type. It's going to show you the 52-week highs, lows. It's going to show you the FFO. Remember, for real estate, you want to follow that FFO, funds from operations. Earnings do not show profitability for real estate investment trusts. Okay, earnings, they have all that depreciation taken out in the income statement, and earnings are completely false, completely manipulated, so they don't show really the real cash flow potential for REITs. You want to watch this FFO, the funds from operations. Okay, that's like those earnings per share, but it's funds from operations per share. It's going to show that for 2023, 2024 expectations for each of these, the price to FFO, so that valuation for each of these, FFO growth. Going to be a lot of data here for those to really look through. Okay, so we looked at what property types we're interested in investing. Now we can look at what stocks are in those property types and what we might want to look at. And I'm going to go down here to page 39, which is healthcare. So you see in these, you got regional malls, freestanding malls, retail. You've got shopping centers. So you've got all the property types here, as well as all the real estate stocks in them to look through them. We're gonna go here to healthcare. So again, very, very interested in healthcare. I think the demand is there. I think it's sold off at 22% last year, so the valuations are good. You can kind of look through here. I like, Medical Properties Trust, ticker MPW. It's still paying something like a 14% dividend yield. And we can look through here and look at what that's actually paying now. I mean, this stock has rebounded. It's up. It's paying 12% right now. Right now, you can just look at, it's rebounded from $7.39 there in May all the way up to almost $10 a share now. So it is up. It is up almost about 50% just in the last couple of months. And again, I think it's on a couple of factors here. But what we talked about was that those hospitals are now showing better fundamentals. They're now showing better reimbursements from the government for those healthcare services, and that's flowing through into these healthcare, into these healthcare owners, these real estate owners. Okay, so MPW up, something like 50% over the last couple of months as it diversifies away from those top two tenants that were having problems. We're seeing a very good cash flow from the company, cash flow that easily covers that 12% dividend, and the price to FFO on this is just ridiculous. You go up here, FFO, price to FFO per share, 2023 estimates. Here you go. If you look at an average here of about 11.9 times. So for the healthcare sector, real estate stocks in the healthcare sector, you got an average of about 11.9 times price to FFO. So price divided by funds from operations. You look at MPW, Medical Properties Trust, trading for just 5.3 times price to FFO. That is the cheapest in the healthcare sector here. You've got a few others. You got Diversified Healthcare Trust, ticker DHC, trading for 5.7 times. You've got a couple of these under 10. You've got Global Medical REIT, GMRE, trading for under 10 times price to FFO. But Medical Properties Trust trading for just 5.3 times on a price to FFO basis, paying that 12% dividend yield. And I think a dividend yield that is safe from a cut. So, I know a lot of people were worried about that. I think it is safe from a cut now, and we're starting to see better fundamentals on that. Also want to look at these we look at these lodging and resorts, a lot of these in the news. This Ashford Hospitality Trust, they just sent about 19 properties back to the lenders, defaulted on about 19 properties just recently. I know Park Hotels, ticker PK, that's another one that is defaulted on 2 huge properties there in San Francisco. So, you look at these lodging and resorts, you want to do your research still, okay? You cannot just invest in whatever looks the cheapest in these. You have to do your research, see what parts of the country these stocks or these REITs, these real estate companies are investing in, what their fundamentals are. But some of them do look good. Host Hotels and Resorts, they're always a fairly decent one to look at. You might also check out the Apple Hospitality REIT. That's ticker APLE. Look at that one. But again, these lodging and resorts, these hotel properties, it is all interest rate based weakness. Okay, we do still have some good consumer spending, still good travel spending, supporting the fundamentals in that industry. So once we do get interest rates start coming down, I think you're going to see it there in those real estate stocks in there. Infrastructure, so cell towers, those also got hit very hard last year. We saw that in that property. Overview here. If we go back to that, we see infrastructure down 28% last year, up just or down another 10% this year. So down 28% last year, down another 10% so far this year for those infrastructure, mostly cell tower REITs there. So definitely looking for some bargain hunting there. You look at AMT, American Tower Corporation, Crown Castle, 2 of the largest cell tower owners in the world, really. Look at some of the price to FFO estimates. American Tower is still trading fairly expensive at 19 times price to FFO, so that's a little expensive. Crown Castle, it looks like 14.8 times, so a little expensive versus some of these others. Do your research though, but I think I think even at that price to FFO, you probably could still get some pretty good deals in these if that infrastructure asset class has been hit over the last couple of years. Last group I want to talk about here is going to be the commodities place. Okay, commodities. We could be, if we are running into a new bull market, we could be into a new commodity super cycle. Okay, Goldman Sachs has actually been predicting some kind of a commodity super cycle for the last couple of years. It got hit obviously by the pandemic and lower demand from China as China really went into those pandemic lockdowns and just came out this last year. So that hit a lot of commodity prices. But with China stimulating their economy, with the U.S. Staying fairly growthy looking over the next year, and then moving into that next bull market, then these commodities are positioned for a really massive supply deficits in some of these. Okay, specifically I'm looking at copper, some of these rare earth elements, and even oil. Okay, if we look at copper, and this is something we've been talking about on the channel. This is one of my biggest themes here over the next 5 or 10 years is the supply deficit in copper. Okay, what we're seeing here is not just electric vehicles. Okay, electric vehicles need 3 times the amount of copper as an internal combustion engine vehicle. Okay, you got about 50 or 60 pounds of copper in an electric vehicle or an internal combustion engine. You got about 3 times that in an electric vehicle, obviously, because that electric charge needs to be carried everywhere, and copper is a very good conductor of electricity. But not just electric vehicles, anything electric. So that trend to electrification and green building, that green energy build out across the world is just booming our demand for copper. S&P 500 S&P Global research here says copper demand is expected to grow 8.2% a year-over-year growth in copper demand over the next decade, well over supply growth. So you see the chart here. This demand curve is in blue here, and that is every year the high ambition and rocky road. These are just kind of weird supply estimates, I guess, for S&P, but you see the demand curve gets higher and higher. This the supply deficit. So the difference between this blue line, which is demand, and the supply, which is going to be these bars here. The difference between this supply and the demand, that gap just grows and grows all the way through 2035, maybe even beyond that. But so over the next 10, 12 years here, we're going to see a huge supply deficit of copper. Goldman Sachs at one point was estimating copper could be something like 15,000, 15,000 per metric ton, I think it is. That was something like 2 or 3 times what the price was at the moment. We obviously, with the slowdown in China, we haven't seen that, but that's still, as that copper supply deficit grows, you're going to see the price of copper take off, and so, one of my favorite themes right now is getting ahead of that and owning some of these copper miners, copper futures, things like that. Probably the easiest way to do that here is this Global X Copper Miners ETF, the ticker COPX. Now, the upside to this is, one, it owns, all those copper miners, so you don't have to worry about any one company just, screwing the pooch on that and destroying the company and destroying your portfolio. You get all the copper miners, you get more of a broad exposure into that theme. Plus, you get that 2.4%. 2.4% dividend yield, right? If you own copper outright through copper futures, then you don't get that dividend yield. If you want to see specific companies in this theme, specific companies you might want to look at, you go here to the holdings in the menu. Again, this is the Global X Copper Miners ETF. It's going to hold those miners. You scroll down here and you see it's got, London Mining Group, Ivanhoe Mines. I like Freeport-McMoRan. I've owned Freeport McMoRan for quite a while, ticker FCX. All of these are about 5% of the fund there. Glencore is also in there. It's another very good copper miner, copper play there. Now, if you want to own copper outright, but you don't quite want to do futures trading, you can go here to the CPER. This is the United States Copper Index Fund. It is going to track copper prices without the hassle of trying to roll over those futures contracts month to month. Okay. So every once in a while, I'll invest in futures contracts, but you do have to roll those over. And what we're looking at here is, a multi-year increase in copper prices. So not something that you can trade month to month with those future contracts, but it's very easy to do that here in the United States Copper Index Fund, the ticker CPER, but it does not yield anything. Okay, that's the one thing that I don't like about the copper funds, the futures. They don't yield anything, so I would prefer doing the COPX, that copper miners fund. So not only do you get that upside when copper prices do head higher, you also get that 2.4% yield while you wait on that. Something else I'm looking at here, obviously with the growth in electric vehicles, one of the big hurdles, one of the big bottlenecks right now is those rare earth elements like lithium, some of the other battery metals that are going into these cars. And there just isn't enough of them. Okay, China controls upwards of half or more of the mining of these rare earth elements around the globe. So we're already starting to see a supply deficit on these, and I think this is another one of those really good long-term themes that you can be confident is going to provide you those returns over the next 5 to 10 years. Easiest way to do this would be the Global X Lithium and Battery Tech ETF, ticker LIT. Okay, it's going to hold all of those, to show you how bad this supply deficit is going to be in lithium, in some of these rare earth elements. Chile just announced recently, a couple of months ago, announced that it would be nationalizing its lithium deposits by 2030. Okay, so it gave all the companies in the country, all the companies operating in the country, including big U.S. ones like Albemarle, it gave them warning, 7-year warning, that by 2030 it was going to nationalize its assets. Okay, it was going to nationalize those fields. Those companies would have to deal directly with the government, and in those fields, and they couldn't own. The government would own those lithium deposits. So this is what countries are looking at with the supply deficit of lithium, of some of these other rare earth elements. They're looking at protecting their own resources for their own citizens, and probably profiting a little bit in the meantime. But if you want to look at, again, for any ETF, if you want to look at what are the stocks held in that ETF, maybe invest in some of the individual stocks instead of the ETF, you go here to holdings, you scroll down, so you see Albemarle, there is 9% of this Global X fund. Tesla, is part of that fund. They're not necessarily really the minor of those, but obviously it's going to be, it's going to be related to that. Panasonic Holdings, most of these are, electric vehicle stocks. Rivian is in there. Sociedad Química, ticker SQM, that is the big Chilean miner of those. Of those lithium there in Chile. So that's also another good one for a direct exposure into those rare earth elements and the mining. Also, you want to look at, just over the next year or so, you want to look at oil. Okay, oil has been very strong, right around $70 a barrel, with price cuts or production cuts from OPEC and Saudi Arabia. Now, what you got to understand about OPEC and a lot of those countries, especially Saudi Arabia, they need oil right around $80 Brent. $80 Brent, $70 WTI, or West Texas Intermediate, the benchmark that we use here in the United States. They need it right around that amount to balance their budget. Okay, their government budget. They need oil to stay right around that amount to be able to balance their government budget. So they're going to cut production. They're going to support the price of oil so that it stays right around there. That's why oil has been so strong, even in the face of a weakening economy. And what I'm watching here is that if we do move on to a next bull market and economic growth here over the next couple of years, that price of oil could easily hit back up to $100 a barrel. Okay, that's what, again, Goldman Sachs and a lot of these investment banks, a lot of these analysts have been talking about a global or a commodity super cycle here in the next couple of years. So I think you go back to looking at some of these energy stocks. They have underperformed so far this year, just with that, kind of weakness and stagnation in the price of oil. But you've got some of these like Devon Energy, one of our favorite ones from the last couple of years, still paying about a 9% dividend yield, which is very strong for an oil company. These companies, even with oil at about $70 a barrel, they are still cash flow machines. Okay, most of these companies, Devon included, have cost of production right around about $40 a barrel, $45 a barrel at the most. So $70 a barrel oil is still cash flow positive for these companies. Anything above that is icing. Anything above that is going to be share repurchases and dividend growth. And I think that's what you're going to see over the next couple of years for these companies, for these stocks. I want to turn it over into question and answer. Great to be back with you live here after so long. So I want to answer all the questions I can here. Again, check out that revenue share last day to become an investor in the Let's Talk Money community. I posted that as a pinned comment there. The link to that, you're going to get, not only are you going to get monthly income that you can cash out every single month, but you're going to get also those perks that come along with being in the investor community as well. So check that out. Again, last 12 hours to do that, and I'm not going to be issuing shares again. So make sure you take advantage of that. I want to scroll up and see what questions we got. If I don't see your question, go ahead and ask it in the comments or in the chat there. I'll try to get to it. Make sure you use a question mark so I can see that it is a question, and I'll try to scroll down here and see what we have. See a lot of great, great to see everybody here from the Bowtie Nation, from Greece. Sanford, good morning. Marvel, good to see you there. Lakeland. Oh wow, Kevin's close. Lakeland's about 30 miles away or so. So we're real close there now, Kevin. Quiggs, good to see you. It's been a while. I'm trying to find some questions here. Wow, from Jordan. Okay. Oh, so Gabriel wants to know. Okay, so on those revenue share units, again, I'll just put up the chart there while I'm answering this. So you see here, it wouldn't let me buy, Gabriel says it wouldn't let me buy Diamond. Sorry, those are all sold out. In fact, we started with 80 tokens for that Diamond level. Those sold out within a couple of hours, actually. So we upped it. I refiled with the Securities and Exchange Commission to increase that Diamond tier token, and those have again also sold out, here over the last week. So those aren't available. What you can do is just, some of those platinum tokens are available. You buy one of those, and I'm going to make a lot of these. I'm going to make a lot of these perks available to everyone. I want to give you guys all the return for your money you can get. So you buy one of those platinum tokens, $124. Again, that is one time, 1 month. You buy that and you have an investment in the channel. You get that monthly income from the channel. You're gonna get all these, access to the private Discord channel where we're gonna have real-time notifications of stock buys and sales, the investors meetings, the live streams, the portfolio tracker spreadsheet, as well as any future video course or book. You can get all those perks and access completely free with those, and then you're also going to get that monthly income from that investment. So, but it's a one-time thing. You do that, and you're going to be part of that investor community. So check that out. 12 hours left in that. What else? Kenneth says, I just got here. Did he say on SoFi or Palantir? Covered SoFi earlier, haven't covered Palantir. I would put it, though, also within that growth stock idea that if we are heading into a new bull market and interest rates are going to be coming down over the next year, then I think, Palantir, you also get that upside there as well. Obviously, with the AI boom, with the AI bubble, maybe, then Palantir has come up quite a bit. But, obviously, this is a company that, again, what we're looking for here is companies dominating their industry, dominating that new way of looking at something. So with Palantir, it would be about, online data as well as data and security and AI. SoFi, it would be online banking. Companies just really changing the way we do things and dominating that market. So I think you can definitely say that about Palantir, and that's something you want to be in for the next 5 or 10 years. Over the next year, it might get dicey if that AI bubble bursts and you start taking losses. But you have to take a long-term view on these kind of growth stocks. Okay, just look at the price chart of Tesla. We can go back here and look at this, and I'm actually doing a chart or doing a video on investing $100 a month and what it why it's probably the easiest and best investing strategy for people. Because if you look at the price chart for Tesla, here over the last 5 years, if you were unlucky enough to start investing right at that November 2021 peak of about $381, you would still be at a loss. But if you invested $100 a month regularly in Tesla, you would now actually be up 14%. From that over those last 21 months, right? You'd have $2,100 in it, $100 a month. You would be at something like $2,500 total, because you would have taken advantage of all the way down and bought shares all the way down. That's what I think you got to do for these growth stocks, okay? Because even if you look even further out, and we can't see it, you can't see it really well here. But if you look anytime in Tesla, it is just a roller coaster of prices. And that's with any growth stock, Palantir, SoFi. It is a roller coaster up and down in these prices. And what you have to do is you have to just continuously a dollar cost average up and down, wherever the price goes each month, put a little bit more in it. You're going to take advantage of those lows whenever they come around, and you're going to make a lot of money over the years as those growth stocks really prove out that growth theme. So didn't necessarily talk about Palantir, but I think it's definitely one of the stocks you want to be in there. Grab Progressive. What else? Filipino from Tennessee. What else? I wonder what would be the perfect time to buy 10-year U.S. Treasuries day of the Fed rate hike, days before or after. Trend Board wants to know about trading U.S. Treasuries. That's tough because obviously, the market is pricing in the expectations for what the Fed is going to do, not necessarily surprised at what they end up doing. Once we get up to the Fed meeting, we pretty much know what the Fed is going to do because they're pretty good at previewing through their speeches and through their commitments what they're going to do with those Fed rate hikes. So, it definitely wouldn't be waiting until the Fed rate hike comes to invest in those treasuries, but being well ahead of time. What I will say when we're looking at bonds, though, is that could be another, for extremely risk-averse investors out there. If you really just want to protect your money, you are getting a very good return in bonds right now. If we look at something like the HYG, which is the iShares High Yield Corporate Bond ETF. Now, this is in companies with a little bit lower credit rating, but still very strong credit companies. They're bonds, so they're safer than stocks. Paying a 5.6% yield. I know I think it's the SPHYD or Somebody had a question about it earlier before the stream actually, and we looked at that. The SPHY. Look at that. SPHY is another high yield bond fund. Charges just 0.1%. So very low expense ratio on this Spider Portfolio High Yield Bond ETF, paying a 6.9% dividend yield. Okay. Now, you're not going to get much price return out of these because they're pretty much paying out all the interest income as dividends, up until just the bond apocalypse last year, right? This was pretty well stable, even in good times and in bads. And that's what it's going to be, high yield bonds, they're going to follow the economy a little bit more. They're going to be a little bit more volatile than than regular bonds, and then corporate or investment grade bonds, which you would get with something like the BLV. Okay, if you want really safe bonds, the long-term bond fund by Vanguard there, ticker BLV, that's going to pay a 4% dividend yield. Okay, and we know what happened to bonds last year. As interest rates come down, you're also going to see the the rebound for bonds from that. Okay, so if we look at what happened to bonds, last year, here we got 2021, 2022. This BLV fund was at 104, came down to 70s, right now into 75. So as you see interest rates come back down over the next year, you're going to see this bond fund come back up to $82, $90 a share. You're going to get that 4% dividend yield. You're going to get bonds, which obviously much safer than stocks. And you're actually going to get some price appreciation as well, which is pretty hard to come by in bond investments. So, I think especially for the investors out there that are a little bit worried about the market, just don't want the risk, want to protect their money as much as possible. Bonds are looking very attractive right now on those yields. What else here? I saw Melanie in there. Melanie Struck, longtime Bowtie citizen, Bowtie ambassador, in fact, I think. He's about to suggest the core satellite. Okay, so she's actually answering a question or a comment from before. I'd love to see that. Love to see you guys talking back and forth and answering questions. So Diego asked, should I buy a single stock or an ETF? And really, like Melanie says, the best investing strategy you can use, folks. This is something I use with my own portfolio. Use the core satellite strategy. If you look in our videos, go to the channel, go to videos, search for core satellite. You're going to find some of the videos that talk about it. Basically, you're holding 60, 70%. So most of your money, 50 to 60, 70% of your money in ETFs. Okay, so those big funds, it's going to give you broad exposure to stocks, bonds, real estate, give you really that overall exposure to hundreds, thousands of stocks and bonds, things like that. You don't have to worry about that portion of your portfolio. That is going to leave just the 30, 40% of your money left buying individual stocks if you want to. You don't need to. You can have a total fund portfolio if you want. But just having that limited ability to invest in those individual stocks really going to save you a lot of time and make research a lot easier, right? You're only going to want maybe 10 to 15 individual stocks. So you only need to find 10 or 15 that you really like and really want to hold for that long term. It's a great strategy, very easy strategy, and something that's going to give you those market returns and protect your money with that ETF portion, but give you a little bit upside return possible with the individual stocks as well. Okay. Ambrose is here. I was in a meeting at 11, he said, but it looks like he's here. I was asking just because single stocks. Okay, could be. Okay, so yeah, Diego's saying, with this environment, individual stocks, obviously, with the stock market doing better, then individual stocks are going to outperform, right? Because, some individual stocks, right? You've got that option, you got that possibility or the potential to get that upside return on an individual stock that's going to go, 20, 30, 40% or higher. Whereas a fund that holds hundreds or thousands of stocks, it's obviously going to be averaged out. So the winners and the losers going to average it out to a much lower market-based return. Which is really what we're looking for with that core portion of your portfolio, 60, 70% of your portfolio in those ETFs. You're just trying to get the market return. You're just trying to ride that very long-term, 20, 30-year long-term upside in stocks, not even have to worry about it. It's totally stress-free portion of your portfolio. Then with those individual stocks, the smaller portion, you can you can ride that upside potential from the individual ones. Okay. Manuel, hey Marine, how much do you suggest keeping available in our brokerage account? 5-10% for cash. So I'm assuming, Manuel, you're talking about cash here. He wants to know, how much money do you suggest we keep available in our brokerage account? So I guess this would be cash. This is part of that portfolio allocation, right? So you've got maybe, depending on your age, maybe you've got 60-70% in stocks, 15% in bonds, just for that what if, right? And those good yields, maybe even a little bit more in bonds, maybe 10-15% in real estate stocks, things like that. That's going to give you a very good diversification across the asset classes. Then, yeah, it depends on, what you're looking at with the market. Right now, I'm down to about 10% of my money in cash, just, money that I might need for, some kind of expenses that come up, or just to take advantage of anything in the stock market that I see that I want to buy. I would say, maybe about 5-10% in cash is fine, as long as you have some of these other investments. Okay, if you've already got 10 or 15% in bonds, that's going to be kind of a cash-like, safety asset as well. So if stocks fall, bonds usually go up. Last year they didn't, but usually bonds will go up if stocks fall. So if you do have some of those bonds, you can also sell some of those to take advantage of those lower prices in stocks. If you don't have bonds, maybe you want to hold a little bit more in cash just in case for that what if scenario. But yeah, 5 or 10%, you always want to have some cash available, a little bit. If you're in a brokerage account that gives you, some kind of a yield on that, you're really not missing out on a whole lot by just, holding that over, month to month. Base wants to know, how do I get in your Discord? Discord isn't set up yet. It'll set up. We'll set up a Discord channel today as that revenue share IPO closes, and then I'll be sending out an email to investors how to get on Discord. How to get on that and how to get access to all the investor perks and access and benefits to that. So that'll happen over the next couple of years. I'll send out an email to to all the investors in there on Gigastar. Where do we park 12,000? So IMJ wants to know, where would you park 12,000 from CSC credit card arbitrage right now through 5/20/24? So evidently it seems like IMJ has moved some money around on his credit cards. He's got a 0% interest rate on those. So he's got a new credit card that he took $12,000 out. He's got that for about a year, 5/24. Now the thing is, man, that kind of short-term investment, you really want it safe, because if 5/24 comes up next year, or 5/20/24 comes up next year, and you don't have that money to pay back, you're going to get hit by all that back interest that they didn't charge you because of that 0% introductory rate, right? So you're going to have a lot of interest you got to pay if you can't come up with that 12,000. So this has got to be money that is super safe. Anytime you have expenses coming up in the next 12 months, it's got to be very safe investments, right? So I would be looking at, any kind of a no penalty CD, any kind of money market fund, something like that. Those are all paying right around 4% right now, which is a decent return for that kind of safety. It's not going to be a lot of money, but it's going to be something on that 12,000. I know you're going to be tempted to say, hey, well, I can get a dividend yield of 12% in such and such stock. Well, yeah, but you could also lose, 10 or 15 or even 20% on that stock price. And when you go to cash out, you have, $7,000 or $8,000 instead of 12,000, right? So this has got to be in something very safe. Even with the stock funds or even with the bond funds, I would avoid anything long-term bond fund. I would go maybe the BSV, ticker BSV. That's the Vanguard short-term bond fund. That is going to be quite a bit safer as far as interest rate moves and that kind of thing than some of your other your other bond funds. So that would probably be the riskiest thing I would go into, is that BSV, that short-term bond fund. And that's not going to get you even as much as, probably some of the money market or no penalty CDs that you can set up. What's your opinion on Toyota and this hydrogen engine? So the Quags wants to know about Toyota news on the hydrogen engine. I'm sorry. I know they've been setting up something as far as a solid state engine that's big news lately. I really haven't looked into it yet. I know Toyota is, even that aside, is really becoming a name in the electric vehicle area. It's actually, I did a valuation of Toyota, Ford, GM, and Tesla couple of weeks ago, actually, and Toyota looks like a nice kind of midpoint It's got the growth in the EV, a little bit better growth in EV than some of the traditional car makers, not nearly as expensive as Tesla, obviously not nearly the market share or control on EV as Tesla. But I think Toyota is, another one of those that's a very good upside on the EV revolution over the next 5 or 10 years. Probably not to the point of Tesla or Rivian. I mean, I still like Rivian better. I still like Tesla on that robotaxi upside. So if Tesla can benefit from that robotaxi project that it's got going on, it's going to do better than the EV car makers, even the traditional ones that shift. Then that would be something to look at. But I really haven't done the research on it to be able to say one way or the other. So baptism in the ism, commercial property in trouble. Yes, it has been. Commercial property has been getting hit hard over the last year. It's still in free fall. We're still seeing property owners let the properties go back to the banks. But of course, with any of this stuff, you have to be ahead of the market, ahead of those inflection points in the market. I think the big inflection point in the market for commercial property, for real estate, is going to be when the Fed does cut interest rates. Okay, again, we're expecting that probably in January, March of next year, maybe even December if the economy weakens further, or if the real estate market weakens further even. That is going to be the inflection point. Now, of course, the market is going to turn before that. Market is going to be previewing that, predicting that, and is going to turn before that. So I think, even before that, you start gradually making your investments into some of these real estate investment trusts. Okay, be bargain hunting as they come down on the way down, and watching that long term. Keeping an eye on that long term view. Okay, because if you do go in and those stocks lose another 5 or 10% because the commercial property market continues to weaken, if you panic and sell out of those and take that loss, then you're going to miss out on that bigger long term picture when that inflection point happens, when those real estate prices do turn around. And again, I think we've got a few years here of where commercial property and real estate stocks are going to be some of the best performing stocks in the market, just because as those interest rates do start coming down. Okay, so baptism in the ism says they're worried about NYCB. I don't know why. I don't know why you'd be worried about it. It's been doing very well this year. New York Community Bank Corp. It's one I've owned for a couple of years now. It was just an absolute dog for a while, and did nothing. Very strong dividend yield. Dividend yield as high as 7.5% at one point when I was investing. Now it's down to 5.8% just because the shares have come up. What happened to turn this stock around? You see here, just over the last year, it is up from, during the banking crisis, it hit about $6.50. But for the most part, it was right around $8.50 a share at the lows here over the last year, and now is up to almost $12 a share. What happened is New York Community Bank was able to step in when Signature Bank of New York failed and was put into receivership by the FDIC, right there in March when we had all those regional bank troubles there. The Signature Bank of New York failed, couldn't cover its deposits. FDIC took them over, and New York Community Bank bought a lot of those assets on the cheap. They got a great deal on a lot of those assets, a lot of those deposits and accounts from Signature Bank. Got a great deal on those. That really shored up its cash flow. Okay, so what investors are looking at here that drove this stock from that $8.50 per share up to almost $12 a share is that the cash flow is very much better covered here now in NYCB. It is getting a little bit pricey here at $11-12 a share. The dividend yield has come down to 5.8%, which isn't nearly as attractive as when it was right around 7 or 8%. So, I'm holding my shares. I'm not buying more. I'll probably sell. I've sold some covered calls here at $12 a share. So, if the shares hit $12, then those shares will be called away from me. That investor will buy those from me. I collected that premium. I think the premium was like 80 cents I collected on those. So basically, I have upside all the way up to $12.80 on these, and some downside protection with those covered calls. But, I've been in this a couple of years, been talking about it for a couple of years. It's great to see it finally come back. And really, besides that 6, 7, 8% dividend yield that I've collected on a year-over-year basis on those, it's nice to see the price come back as well. But yeah, it's getting a little bit expensive, a little bit stretched here, at $12 a share. Second property, more land. What else? How do I get in Discord? Okay, copper still needed. What are your thoughts on where the Dow finishes the year? Okay, one drop on TV wants to know where the Dow is going to finish the year. You know, folks, I don't know. Nobody knows. Okay, you hear all these analysts talk about price estimates, targets for the Dow and the NASDAQ and all this. I can tell you, again, you know, I think we're in kind of a Goldilocks scenario for stocks. Okay. I think we are in a Goldilocks scenario for stocks. Okay, again, you know, if economic data continues to be good, if the jobs numbers are good, if consumer spending stays good, then obviously that's good for stocks, right? Stocks continue to rebound. They're at about 4,500 now on the S&P 500. You know, I think it goes up maybe marginally. It's already come up like 20% so far this year on the S&P 500. So a lot of this year's gains are probably out, 4,600 maybe on the S&P 500, maybe a little bit higher. So that's if the economy stays strong. If the economy drops, then we've got all the room we need to cut from the Fed, cut interest rates, right? With that inflation number is the key, and that's what we've seen come down over the last 6-7 months. We've seen that come down close to the Fed's target, and that enables the Fed to support the economy when it needs to. So economy good, stocks up. Economy bad, stocks probably up too, because they're going to be looking forward to the time when the Fed starts cutting rates and supporting stocks, supporting the economy. So I think longer term is what you gotta be looking at. It's so much easier to look long term and see where the economy is going than try to say, okay, over the next 6 months, where are stocks going to be? Over the next 6 months, where is the Dow or the S&P 500 going to be? That's what you really gotta pay attention to, those longer term trends that are a little bit easier to kind of follow. What else we got here? Lifters Gym. Chad Taylor, see you there in the comments. Great seeing you there, man. Bowtie ambassador Chad there. Okay. Jose Pascual wants to know, how can you find good valuation on different sectors? That's one resource I use is here, and I can share my screen for sector valuations. I like to use the Morningstar index or Morningstar data. If you go into any stock, so let's use let's use Tesla. If you go to Tesla here, go into any stock and then go into valuation on Morningstar, and it's going to show you kind of the historical the historical averages, price to sales, price to earnings, price to cash flow. You scroll over here, you'll see the index. So the index average for those. Now, obviously, you gotta take this with a grain of salt, because some of these, obviously, Tesla is going to be in automotive, the automotive industry, the consumer, consumer discretionary sector. Very much different from most of the companies in that sector and in that industry. So, obviously, price to sales of 11 times price to sales ratio versus 2.4 for the sector. That is obviously, makes Tesla look extremely expensive, but Tesla has the growth to back it up. Price to earnings also very much higher than that. So, that's one resource for those price to or for sector valuations, things like that. You can also just kind of do it manually. Go to the top largest five stocks in a sector. Go to their price to sales. Go to their statistics. They're on Yahoo Finance. Click on statistics here. It's going to give you the price to earnings, price to sales, price to book, all of those. You take the average of the top 5 or something, and that's going to be pretty close to the average for the entire sector, because top 5 for market cap. Those are going to be basically the ones that are going to move the sector average. What else here we got? Thank you for perspective. It's considered something like PDI. Give me points to consider. Okay. What good stock to buy when you only have $100 to put in it today? Okay, great question. Travis wants to know what's a good stock to buy when you only have $100 to put it in today. Very important, very good question. And the answer is none of them. if you only have $100, you do not want to put it all in one stock. Especially if you're just starting out investing, you're just starting your portfolio, you never want to have everything in one stock. Okay. What you want to do, you want to make sure that you're on a platform, on an investing app that has fractional shares. Okay. This is something like, I know Robinhood does fractional shares. I know M1 Finance does fractional shares. Basically, you can break up that $100. You can put $20 in one stock, $20 in another. Doesn't matter what the stock price is, you have $20 of that stock price, right? That's going to be your best way to really invest in a group of stocks, and not just have to worry that one stock that you put $100 in just crashes and burns your entire portfolio. Okay, you never want to have all your money in one stock, even in a group of stocks. Okay, we talked about that core satellite strategy where you have most of your money, 50, 60% in ETFs and funds, and then the rest in 10 to 15 individual stocks. This is a great way to do that. You take that $100, and you go to M1 Finance or whatever. Say you've got your 3 to 5 ETFs that you really like, some stock funds, bond funds, some real estate funds, whatever. You got those. You put maybe $50 or $60 of that money in those 3 to 5 funds. Okay, you tell M1 Finance you want 10% in this fund, 20% in this fund, so on and so forth, up to 50, 60, 70%. Then with that other 30% of your money, that other $30, then that's when you're going to pick those 10 stocks that you really like over the long term. You really like for the next 10 years. And don't feel like you have to do this all at once, all today. Okay, I know $100 available today. You don't have to invest today. You are going to miss out on nothing. Okay. If you don't invest right now, right this minute, you're not missing anything over the next day, over the next week, even over the next month. If we look at investing over 10, 15 years, that month, that week, even that year means almost nothing. Okay, so do your time, do the research, find those 10 or 15 stocks that you really like. You can be confident in them. You're not going to panic when they drop and sell out of them. Those 10 or 15 stocks that you really like for the next 10 years and invest in those, but wait until you find those to really invest, because the worst thing in the world is to be wishy-washy on a stock, not really like the stock, but think you have to invest, you have to get that money invested, and then see it drop and just panic sell and take the loss. Okay, you want to be in stocks that you love for the next 10, 15 years. So find those, stick with those, and and you're going to be happier and you're going to be wealthier over the next 10, 15 years. You're going to make more money, right? What else do we have? What are your thoughts on buying a mortgage lender early when the rates get cut like rocket? Good question, Charles, there. What are your thoughts on buying a mortgage lender? So mortgage companies, when rates get cut, they should do well, right? We should see what one of the biggest challenges to the real estate market, the residential real estate market anyway, is that upwards of, I think it's like 50, 60%, maybe even 70%. It's been a couple of weeks since I've seen the numbers, but maybe upwards of 70% of mortgages, they are locked into rates of 3 and 4%, right? So they cannot sell. Okay, why would you sell your house if you're just going to have to buy something and have a 7% interest rate, right? Or have to rent? So that takes an extreme amount of houses off the market. People aren't going to be refinancing. But when interest rates do start getting cut, then yeah, that's going to help the mortgage lenders. That's going to help the overall real estate sector, like we talked about. So yeah, I think it's a great idea. Obviously, I think there's still some pain to come in those mortgage lenders, because obviously we're not looking at rate cuts until January or March. The Fed will increase interest rates here in later this month in July 26th when it meets. So that's going to be another higher impetus on interest rates. So I think you're still going to see some pain or weakness in those mortgage lenders, in those stocks. But again, you don't want to wait until the inflection point. You want to be early to the game and just have faith that it is going to turn. So maybe a couple of months, maybe wait a couple of months and get in those, as well as the greater real estate sector and grab some of those. What else? Opinions on Rivian and Lucid considering the EV market. Okay, so Michael, late to the forecast, but yeah, I talked about Rivian. It's probably my favorite EV stock right now, obviously because it's made me so much money. I was in their cost basis right around $14, so I'm almost double my price on Rivian there. Again, like all of those growth stocks, like a lot of those growth stocks, it has just jumped over the past few months, getting a little bit pricey. So you definitely have to look at the long-term picture in these, and you have to have confidence in that long-term picture and stay around for that long-term picture. Okay, invest a little bit each month, so you take advantage of those lows. If the stock does come down, you take advantage of that, and you're investing each month, and you get those lower prices. Stick around for 5 or 10 years, and you're going to make very good money. Right? Rivian has proven that it can compete, that it can scale on those production numbers. It is very close, I think, to the point where it starts coming down on the production costs. So you're going to see very much higher profitability in that. And I think the stock price is going to respond in kind over the next few years. What else? What other questions do we have? If I didn't see your question, please ask it again in the comments so I can make sure that I see that. I'm gonna scroll up, see if I got any more questions that I missed there. How do you feel about RITM? Huge dividends quarterly. Let me see. Actually, I don't even know what RITM is. Rhythm Capital. Not sure what Rhythm Capital is. I'm guessing it's probably a business development corporation. Go to profile there, 10.7%. So we're looking at. It's a mortgage REIT. Okay. Yep. So these mortgage REITs, this is a side of the real estate market. Obviously, these companies, they borrow on very short-term rates, right? Sometimes like overnight rates. They borrow on those. They leverage that up 2-3 times to buy mortgage loans, right? So obviously, if mortgage loans are at 4, 5, 6%, then they can get a bigger spread, a very good spread on their money by borrowing their short-term rates. The problem with mortgage lenders here, or these mortgage REITs over the last year, is that yield curve has been very flat, right? So they've been borrowing at these rates that are very high, and the spread, because the long-term mortgage rates aren't that much higher. So the spread has just evaporated in these mortgage REITs. Obviously, I think, as the yield curve steepens like it should be when the economy is growing, then obviously these return to making more money. I've never heard of Rhythm Capital. I haven't done the research on it, so I really can't tell you as far as Rhythm Capital is concerned. A few of the mortgage REITs I do like. Mortgage REITs like, AG&C, probably one of the larger mortgage REITs. That one's going to be, probably a little bit more financial power to withstand any kind of pain in the mortgage market or any kind of liquidity crisis or anything. It's offering a 14% dividend yield, so very strong dividend yield. Obviously, you're going to lose some price appreciation on this. Stock is probably down pretty hard, not too bad over the last year, down from 11.69 down to 10.31. So it's held up pretty well, but you get that 14% dividend yield. But a lot of these, you got to understand, okay, the stock price is going to go nowhere at best. Okay, it's probably going to fall a little bit. You're going to collect those dividends. So these are very much for investors that need that dividend income for their expenses. If you're not spending that dividend income, then I would find a company that's going to give you the long-term price returns rather than just dividends. Okay, because you're paying taxes every year on those on that dividend income. Okay, folks. Anytime you collect a dividend, whether you reinvest it, whether you keep it in your brokerage account, whether you take it out, it doesn't matter. You're going to pay taxes on that come next April. Okay, so that is money that you could have kept invested, you could have had working for you. Instead, you're paying it to taxes. So a lot of the investors out there with all dividend stocks or all very high yield dividend stocks like 14.4% here with AG&C or Rhythm Capital 10%. All those dividends, you're paying taxes on them. So you're losing each year money that you could have kept invested. So if you're not using your income right now from stocks, if you're not withdrawing that money to live on, if you're just trying to grow a portfolio, I would have it more in growth stocks that you're not going to have to pay taxes on until you sell them. Those things like that. I still do own dividend stocks. I still love dividend stocks, and I still have some of those. But they're in like retirement accounts where I'm not paying taxes on it every year, or something like that. Okay, so you definitely need to be thinking about the taxes on these kinds of things. Gabriel says, 3,000 to invest. Should I open a new position in energy or copper? or should I buy the dip in SoFi or Doc? Maybe DocuSign there, or put it into a Thinkorswim and sell credit spreads. A lot of stuff there, Gabriel. But 3,000 to invest. It's got to start with what's your portfolio look like right now. Okay, where are the gaps in your portfolio? Do you have anything in energy? Do you have anything in copper? Do you already have some? He said buy the dip in SoFi or Doc. Do you already have some in those stocks? One, you got to start out with never want more than 5 or 10% of your money in any single stock. Okay. If you've got 10% in a stock and it falls by 20%, then your overall portfolio is only down 2%. You can live with that. Okay, you've lost some money, and the stock dropped, and that's fine. But it's something you can live with, and you're not going to be too distraught over it, right? If you've got 30% in that, if you've got 50% in that same stock and it drops by 20%, you're now down a lot of money. Okay. You are down. That's money that you can't make up with a lot of your other stocks. Okay. The rest of your portfolio has to just boom higher to make that up. Okay. So never more than 5 or 10% of your money in any one single stock. Again, you don't want that many stocks anyway, 10, 15 stocks that you really like. You can really hold on to it for a long time. So it's got to start with what you've got money in right now. If you've already got money, quite a bit of money in SoFi or DocuSign there, then you don't need to buy more. If you don't have anything in copper or that copper theme, I would look to that for long-term play. Energy probably also looking good. Maybe some of those other growth stocks that we talked about. It's really got to start from there and what you want. You also want to, if you've already got 10 or 15 stocks that you really like, you really are confident in, and you can hold them for the next 10 years, then just put a little bit in each month. You don't need to find new stocks. If you really like these 10 or 15 stocks, you do not feel obligated to chase the next hot stock or to find that next hot stock. Do what you do best. Go out, spend time with your friends and family, and don't worry about the stock market because you've got those 10 stocks that you really like. What else? Levi says he used Robinhood but would like some sort of tracked that is more user-friendly. Does anyone have any good suggestions? Okay, so as far as tracking your investments, I use E-Trade for a lot of my stocks. I've also got M1 Finance. I've got, basically just the free stocks on Robinhood. I've got Webull for trading. Webull's got some great trading screens and things like that, but it's not great for that longer term investing, I think. So maybe check that out. A lot of these, try out different platforms. Get the free stocks from them. Get a Webull account and get the free stocks. Try it out for a year and, just have $100 in it. You'll get those free stocks. That's an instant return for free. You see if you like it. If not, you close it out and take your free stocks and run. But you get that. You do M1 Finance, I think, is doing a cash back kind of thing. E-Trade, I think you get $50 or something. SoFi, I know you got $25. I think I've got a link to SoFi in the description where you get $25 free. Check them out, try them out, put $100 in. So just while you're trying it out and get that free cash, and there you go. So one favor should be on the spreadsheet. What else? Looking through divvies. Lost me at USDC. Prefer the next bull run. Okay, so Mark talking about the revenue share, USDC. Yeah, each month the revenue share gets distributed in USDC, but that's immediately transferred into dollars. Okay, each month when that money from those revenue shares, from the channel, from the IPO, from those tokens, each month when that hits your account, you can immediately transfer that USDC into USD, into dollars, put it right back in your bank account. So it's not something that you have to be a cryptocurrency expert or a cryptocurrency fan to do. You can be totally cryptocurrency agnostic and still invest, still convert those directly into dollars immediately and have that income every month. So it's not like you have to have confidence or faith in cryptocurrency or anything to do that. What else do we have? Well, what do you think about a 3-fund portfolio? BND, VXUS, and VTI. Okay, so Charles wants to know about a 3-fund portfolio. Great idea. Just having 3 funds is really all you need. If you do not want the stress and the roller coaster of stocks, following stocks, investing, all that, You invest in 3 to 5 funds, all your money. You put a little bit of money in each month, and you're going to get the market returns. And market returns have been good, and they will continue to be good, and you'll never have to worry about it. Now, specifically, he's talking about BND, which is the bond fund, which obviously you want some money in bonds. So maybe depending on your age, this is the Vanguard Total Bond Market Index Fund, pays a 2.7% yield. And I like some of the other bond funds a little bit better. Maybe the total bond market fund is a little bit safer because it has most of its money in treasuries, right? So it's a little bit safer, but then you're only getting that 2.8% dividend yield. I like, the BLV is pretty close to just as safe. These are very, very highly rated corporate bonds. You're going to get a 4% dividend yield there. So I like that for my bond fund, but the BND is good. Also, it's a little bit safer with those treasury bonds. The VXUS is ex-US, so it's going to be a developed markets, I believe, a total international stocks. Okay, so this is going to be the Vanguard Total International Stock Market. So all stocks except United States, right? So this is your international exposure, yield of about 3%. So this is some US or ex-US stocks, so international stocks, and then the VTI is the US market. Okay, so the VTI, total stock market index, the VTI. Now that is going to be mostly, if you look at the holdings, it's mostly those large cap US S&P companies, right? So if you look at holdings here, the Apple, Microsoft, all these, this is the vast majority of it. So it says it's a total stock market fund, but it's basically the S&P 500, right? Just because of how it's set up with the market cap, it's basically an S&P 500 fund. So what you're getting here with these 3 funds, the BND, the VXUS, and the VTI, you're getting the entire global stock market, right, with the VXUS and the VTI. You're getting the bond fund with the, getting bonds with that. I would like to see maybe a real estate fund as well. I know a lot of the real estate funds, the larger ones like the VNQ, the Vanguard Real Estate Fund, the VNQ, haven't done quite very well over the last couple of years because of the office property in those funds. Because of those. So maybe you buy a few individual real estate stocks, real estate investment trusts for your real estate exposure. But I would definitely like to see some real estate exposure in that besides just the bonds and the stocks. It's just going to diversify it away a little bit. It's going to, help smooth that out. Plus give you a little bit higher upside than just with the bonds, a little bit higher upside with the dividends and that kind of thing. But yeah, again, if you just do not want the stress of picking individual stocks, then just invest in funds, 3 to 5 ETFs, and that's all you need. Put money in that each month. So great question there. This is almost 2 hours. So this is a marathon session. I want to cover a couple of more questions here. Each ET, I see the Quags. Do you like ET for energy exposure? Yeah, energy transfer. It's an MLP. I think they're still officially an MLP, so you're going to get that K1 form. It's never bothered me. K1 forms, they're really easy to do on taxes. It does take some getting used to, so that first year is going to be a little bit harder doing your taxes, but then it's the same every year. And with that K1 form, those MLPs, you get the added benefit of most of that dividend is not taxed as a dividend. It's not taxed, in the year that you receive it. So it's a very, very much an upside compared to other dividend stocks. Very high dividend yield. ET Energy Transfer is one of my favorite for MLPs. I also like Kinder Morgan, which is a stock, but it's the same business model, the same pipelines. So you don't have to deal with the K1 form. So Kinder Morgan, ET, a lot of those MLPs are good. Or you can go with some of I think the AMLP is the MLP ETF, gives you exposure to the entire group. AMLP. LP. Okay. That's the Illyrian MLP ETF. This holds all those MLPs. It's going to hold Energy Transfer. It's going to hold Kinder Morgan. It's going to hold a lot of those pipeline operators. It's going to give you an 8% dividend yield, and you don't have to worry about that K1 form. So, as far as MLP, I do like Energy Transfer on an individual basis, but, it's very easy to get this AMLP, get the whole sector, and not have to worry about individual companies. So maybe a few individual companies, but also the ETF. What else? 3 funds, not many divvies. Okay, JB wants to know, Schwab acquired TD Ameritrade. Should I be concerned? Move to another platform. It's probably going to be exactly the same. There is a reason why Schwab acquired TD Ameritrade, probably for their customer service, probably for their tools and things like that. So they're not gonna wreck that. Schwab's always been very good as far as low expenses and low costs, things like that. I doubt that they would change that very much. I haven't compared the costs between the two, but I'd say see how it works. See how it turns out. Again, you can always test out a few other platforms while you're at it, while you're kind of seeing how that develops. Get those free stocks, get those free cash from other platforms, and just kind of test them out. So if you do need to turn, or if you do need to move your money, then you can do that, and you know which platform you like. But again, folks, there is nothing wrong with having more than one platform, more than one investing account. In fact, you get those free stocks, you get that free cash. It's a bonus. What else? Thanks for answering. Charles platform is okay. So IMJ says he likes the Charles Schwab platform. So maybe they'll bring the best of Charles Schwab over into along with the best of TD Ameritrade. So that would be a win-win either way. Jackie Z wants to know, is SoFi still a buy? I talked about SoFi earlier. I still own upwards of, I still own 18,000 shares of SoFi. So if that gives you any kind of indication of whether I still like SoFi or not, it is getting a little bit pricey here, 1.6 times on a price to book value. We talked about, that's why it got downgraded. I can't remember which bank downgraded it, but a bank downgraded it today on that valuation. 1.6 is a little bit pricey, price to book value for a bank. Obviously, no other bank has a 40% year-over-year revenue growth, so it deserves a little bit higher valuation, maybe 1.4, 1.5, maybe even 1.6. But what I want you to look at with SoFi is the long-term picture, okay? Even if you're just starting to invest right here in SoFi at these highs, that could be a high, could come down a little bit. If you're investing now, start investing, invest every month, every few months, and you're going to be very happy over the next 5 years. Okay, that company or that bank is going to grow into a major bank. It's going to keep on growing, and I think you're going to do very well. Okay, what most rate hikes yet to impact the market? Okay, so Grape Jelly wants to know, most rate hikes yet to impact the market, yet a bull market. So, okay, yeah, I do believe. I don't think most rate hikes yet to impact the market is necessarily true. I think most rate hikes yet to impact the economy. I think that's truer. I do think we still do have to see some economic effects from these rate hikes over the last year, from the fastest rate hike increase in the past 40 years. I think we do still have to see some of those rate hikes flow through to the economy, see the economy slowing down. I think that is true. What I'm talking about here and why I do believe this is the bull market is here to stay is that inflation number has come down to where the Fed wants it, very close to where the Fed wants it, very close to the Fed's target. By the end of the year, it will be much closer to the Fed's target. And I think that supports the idea that even if the economy does weaken because of those interest rate increases, then the Fed is still going to be able to cut rates and support the economy and support stocks. Okay, so basically it's a win-win situation for the markets. Okay, better economic growth, better economic news, good for stocks. Bad economic news, still going to be good for stocks because we're going to get those rate cuts. Okay, so I don't think you need to be worried so much about a bad economy anymore. I think as long as those inflation numbers have come down and still coming down, then I think you're good to go on that. What else? Your views on Indian markets. Sorry, I really can't tell you on Indian markets. Neuron John, I wish I could, but there's limited hours in the day, and I know nothing about the Indian markets. So, I'm sure there's a lot of good YouTubers studying the Indian markets. Haven't really looked at it. I know obviously, India is becoming a major player on the economic scene. I think I saw it's expected to overtake the U.S. GDP by 2070, which is a very long time still, but obviously shows you the kind of growth in the Indian economy and the Indian market. So if you're there, then definitely do your research on that. Okay, is it more like spike again? Fed says they are done with the tightening cycle. I wouldn't necessarily say they're done, but they are, they're very close. Obviously, the Fed has gotten very good at previewing, forecasting what it's going to be doing with the interest rates, what it's looking at, and it is, we're going to see one more rate hike here in July, just because they've kind of committed to that. They've sown their credibility into that rate hike, but that's going to be it. They're going to be waiting, even if inflation, if core inflation stays kind of level here over the next couple of months. I think the Fed is going to be able to say that, hey, the economy is weakening a little bit. We're seeing a little bit weaker jobs picture, so we're going to stay pat here with these interest rates and see how it turns out. Look at your numbers here. You're looking at year-over-year numbers compared to last year. Thoughts on Citigroup for tomorrow? Okay, so Charleston Burt says thoughts on Citigroup for tomorrow. The big banks. We talked about earnings season coming up. Earnings are going to be bad. I think they're going to warn that they could be even worse for Q3. But that's built into a lot of stocks. With the banks, what I'm looking at is, if you look at Goldman Sachs, their forecast for their Q2 earnings over the past month, Goldman Sachs has warned and lowered their expectations by half. Of earnings. Okay, they've dropped expectations by more than half on their expectations for Q2 earnings, right? So they've kind of pre-announced really quite a few times and really warned investors that a lot of the segments of their business are looking very weak. I don't think that is priced into bank stocks just yet. Okay, so I think that could be, you've got the potential to have some bad news there. Goldman Sachs doesn't report until next week, but you've got a lot of the banks here tomorrow reporting. Citigroup, JP Morgan, I think Bank of America might be reporting tomorrow too. There's about 5 big banks reporting tomorrow, and then the rest next week. I think that could be a surprise. I think you could get some negative news out of a lot of the banks, especially the ones that haven't warned quite as much as Goldman Sachs has over the past couple of months. So I think that is a downside risk. I think it might cause a little bit of profit taking in the markets, but I think overall over the next several months, a year, then the stock market looks very strong just because of that inflation number coming down. But yeah, I would be worried about bank stocks tomorrow and over the next week if we do see what Goldman Sachs has been warning us about. Okay, so watch for that tomorrow. If you are in a lot of these bank stocks, and if you want to de-risk a little bit, maybe you sell some covered calls against those. Maybe you look into each individual one, but I think that could be a risk for tomorrow because just what Goldman Sachs has been saying about its own business over the past year. Gold. So Jeff McClendon wants to know, what do you think gold will do? Gold has been range bound under 2,000 for quite a while. I think gold's kind of no win. I find it hard to see how gold wins in this. It's still pretty close. It's at $1,963 per ounce right now. I think it's close to that 2,000 upper end of the range. In the past year, we've seen gold really weak because of interest rates and because of the dollar. Okay, obviously, if you're investing in gold, you're sitting on gold, then you're not earning any kind of yield or any kind of return while you sit on it. Okay. So interest rates are a cost of carry for gold. Okay, you could be in dividend stocks, you could be in fixed income bonds and earn that interest rate. So as interest rates go up, gold gets less attractive. So that's been a problem. High U.S. dollar has been a deterrent or a hurdle for gold. Now, obviously, with interest rates looking like they might come down eventually, then that's a little bit better for gold, but that's inflation. Inflation is coming down too. Inflation has been the only thing really keeping gold up. So it's hard to see that, gold could do much here at this top end of the range, right? If inflation spikes up a little bit, you might get a little bit, higher prices on gold, but interest rates expectations are going to go up with that. And that's going to further keep gold from really going higher anyway. So gold is probably one of my least favorite commodities right now. I know there's a lot of investors that trade that play that gold silver ratio and that. I haven't looked at that in a while. So you might want to see, if which one is cheap on a relative basis between gold and silver, and maybe go into one of those, whichever one is cheap on that ratio basis. What is? Because this is Okay, so TC's laughing his ass off, right? Because this is my research. I mean, folks, I spent more than a decade in, venture capital research, in private wealth management. CFA charter holder, spent a lot of time learning about the markets, a lot of time, obviously, researching the markets, but some bozo and a bow tie on YouTube cannot exclusively be your research. Okay, take control of your stocks, take control of your money, and do just a little bit of research. With these videos, I'm trying to give you ideas into these stocks. We talked about 10 investments, 10 stocks today, between the growth stocks, SoFi, Rivian, Tesla, DraftKings, between the copper ideas, things like that. But you don't need all of them. I'll do a video on 7 stocks to buy or 10 stocks for the next 10 years. But you don't need every stock that I talk about. Okay. You take those ideas, pick maybe 1 or 2 from that you really like, that's backed up by, it doesn't have to be a lot of research, just another couple of hours of your own time, of your own research. Please just, I'd like to think that you could trust me, right? I love my I love my community out there in the Bowtie Nation. I'm going to take care of you, but you're not only getting your information from me either, right? And I gotta say, do not just go to YouTube or go to TikTok to find your investing ideas and go with what they're telling you to buy, because that is not a good investing strategy. Okay, please do a little bit of your own research. Do that core satellite strategy so you're at least getting 60 or 70% of your money in those funds, so you don't have to worry about bad investing ideas from bozos on YouTube or whatever, wherever they may come from. But just, do a little bit of your own research. Don't just take the word of anybody on YouTube, right? Because there are a lot of other guys out there that don't know a balance sheet from their ass. Okay. Honestly, I watch a lot of videos here on YouTube of other investing channels just to see what they're talking about, see how they're doing it. And a lot of them, they're good guys, but they don't know shit about investing long-term. They've been investing all of about 3 years or something, or maybe 2 years, and are telling you, how to manage your money. And that's not good. Take control. I'll get off my soapbox now, but take control of your money and take a little bit more responsibility for it. What else? What sectors should we be focusing on? Craig wants to know, what sectors should we be focusing on? This is a really good question and a really interesting idea from FactSet. See if I still have that up. Okay, so we're going to go to FactSet here. This is the FactSet earnings insight. Again, kind of following analyst estimates, analyst ideas of earnings forecasts. And one of the topics this week was the target price, the difference in target prices, and that. So kind of a neat little chart here. Here we go. Bottom up target price versus closing price. So what this shows you is the target price of all the stocks, according to analysts, all the stocks in each sector versus the closing price of those stocks. So kind of an upside potential for the stocks in those sectors. So it kind of gives you an idea of what sectors analysts are looking at for the best returns over the next year. And a lot of times this is kind of an obvious kind of, okay, well, the stocks in that sector have fallen, so the target prices are much higher, and analysts just see a rebound, right? So you got to kind of question these returns. You got to say, okay, you know what? Yes, energy stocks have fallen. Have they fallen for a reason? Are they going to rebound for a reason? You can't just take analysts' target prices, for granted, because they might just not have updated those target prices yet, right? Those stocks may have fallen for a reason, and the analysts haven't updated the target prices. So this might not be, you don't take this as gospel, but it is a good start to see, okay, where's the value in sectors? What might I be looking at for some of these sectors? And if you see here, energy all the way to the far left, energy expected to return 23% on those energy stocks over the next year. That's according to target prices versus where those stocks are right now. And this is part of what we talked about in that idea that if we do move into a new economic growth cycle, or when we do move into a new economic growth cycle, that price of oil could easily top out at, over $100 a barrel. It is very strong, very strong support right around $70, $75 a barrel right now. It's been range bound for most of this year. Saudi Arabia is intent on keeping that price of oil above $70, above $80 Brent, just because that's where it balances its budget at. So if you've got an upside of $100 a barrel on oil, that's going to take a lot of these energy companies that are already cash flow positive at $70 a barrel. That's going to take them higher. Okay, so that's why you get this 23% upside return on energy stocks. So yes, energy stocks are a good sector to start with. What I'm really interested in here is these next two sectors. Okay, you've got healthcare and utilities. Upside to target price for healthcare here, this next bar is 15.6%. Upside to utilities here is 13.4%. And what's interesting here is not just the returns, the upside return potential on these, but that they're pretty safe sectors too. Generally you think of, obviously, utilities as the ultimate safety sector, right? Because it's a regulated market. They're told exactly how much they can increase prices, and they get those price increases every year. The reason why utilities have fallen so much this year is because a lot of those interest rates, the interest rate increases, okay? As interest rates increase, that pulls investors out of these dividend stocks like utilities into fixed income where they can get a safer yield, a safer, higher yield. So that's pulled people out of utilities. Obviously, stronger stock market, stronger stock market performance also pulls people out of those safety sectors. Now, what you have to ask yourself here, why this has to start with you, is you have to ask yourself, okay, one, do I believe that we're keep staying in this bull market and stocks are going to head higher, and I want to be in growth stocks. I want to be in stocks that are going to perform absolutely the best. Or do I want, or do I question that? Might stocks fall again? Might we head into a recession? Things like that. Okay, so that's one question. Second question is, doesn't matter to me. Do I want just safety? If you want safety, if you just don't want to worry about stocks and that stress of a roller coaster up and down in growth stocks, you might still believe that we're in a bull market, but still just want the safety of utilities. And I think this is a great opportunity for that because, utilities have underperformed. I think it's a great time to buy in at some of those depressed prices on utility stocks and say, hey, even if growth stocks take off and make more money, then I'm still going to be doing pretty well with utility stocks. Okay, I'm still going to be making that return that I need to meet my financial goals. Healthcare, the same thing. Healthcare has underperformed this year. Target prices are 15.6% higher, and healthcare is generally a little bit safer than a lot of these other sectors. Obviously, that biotech and pharmaceuticals part of healthcare isn't quite as safe as some of the other segments of healthcare, but it's still a relatively safer sector. Real estate next here. That's one we talked about, right? Real estate, 13% upside potential to those target prices. Again, this is what I'm talking about with the eventual inflection point with interest rates. I think you start looking at real estate here, if not right now, then over the next couple of months, be ahead of that inflection point in interest rates, because I think it's really going to boost those healthcare stocks. Okay. Wish I knew. Covered calls, just don't understand. Okay, so Snowfire L. I want to know, wish I knew about covered calls, just don't understand it. Don't feel obligated to invest in anything you don't understand. That's stocks or that's investing strategies. Okay. I do a lot with covered calls just because I like to take a little bit of risk out of my portfolio. I'm a very risk averse person. My business, the income is up and down month to month. It's all on me, right? So I want a little bit less risk in my financial assets. That's why you don't see me chasing after a lot of the meme stocks and a lot of the hot stocks and things like that, because I just don't want the risk. Okay. They might boom higher, make a lot of people wealthy. I don't care. I'm making money in my business. I want a little bit less risk in my stocks. So that's why I use covered calls, to take a little bit less risk out. But do not feel obligated just because, somebody on YouTube talked about strategies, covered calls or protective puts or, spreads or whatever. Don't feel like you have to invest in those. If you don't feel comfortable with it, one, don't worry about it, or two, just, slowly watch some videos, understand it, make sure you understand it before you put any money into it. In our private Facebook group, Let's Talk Money there on Facebook, saw a member of the Bowtie Nation, great guy. He's been part of the Bowtie Nation for quite a while, great contributor. But he said, he understands margin investing the hard way now, right? He had $2,000 in his account, borrowed another $2,000 on margin. So he was investing $4,000. $2,000 of that was borrowed money on margin. And, stocks started falling hard, and he took a loss. He didn't know that the loss on those stocks came out of his money instead of the margin account, which, For a lot of us, that understand margin have been using margin or just understand it for a while. That seems like kind of obvious. Obviously, the broker, the investing app, isn't going to let you just lose more money and more money. They're going to take it out of the money that you have, and that's going to change the leverage position in your account. But yeah, he invested on that margin before he really understood how it worked. And now he's sitting at a huge loss, basically probably just selling out of all of his stocks there just to cover that borrowed money. So definitely, understand the strategies you're using. Don't feel obligated to use strategies you don't understand, and make sure you understand it before you're in there. Okay. There's some ETFs that are using. Yep. Okay. So Marco Hungary, there's some ETFs using covered calls. So these are the popular ETFs you see, like QYLD, the JEPI, the NUSI, the RYSI or something. So a lot of those covered call, the income ETFs, right? QYLD is a good example. Basically, they own stocks, then they sell covered calls against those. Well, the problem here with these, and why I usually like just doing it myself, just selling covered calls on my own stocks, these covered call ETFs, the dividends they pay you, 10, 14% dividends, very, very attractive dividend yields. And that's what brings a lot of people into those funds. One of the biggest problems is that those dividends are taxed as income. Okay, because the way these ETFs are set up with those covered calls, with those option strategies, that dividend that they send you every month, that's going to be taxed as income. That's different from most dividend stocks. They're paid capital gains taxes is what you pay on those every year. Again, 0, 15, or 20% taxes sucks to have to pay taxes on those dividends every year. But it's a hell of a lot better than if you're at the 37% tax bracket in income and paying that on those covered call ETFs. So understand, the tax rate on your dividends, especially those ETFs, those income ETFs, and whether basically you're losing most of that dividend to taxes each year anyway. So good. And Nirajan wants to know, am I married? Yes, I am, happily for about 14 years. So this one's gone. This one's out of the pool. Sorry, folks. What else? Devo dividend stocks. Marcos Hungary brought up Devo. It's a very good dividend stock. Haven't looked at it in a while, but it is a solid dividend yield. I know that is the Amplify Enhanced Dividend Income ETF. Actually, I think this might be. What else? What is this? It's a 4.7% yield. 0.55% expense ratio, so not too high, but something to look at for dividend income. Paul, yep, his wife's a nurse. Yep, my wife's a nurse. Wife's a nurse. Kids 7. Samantha just turned 7. Michael will turn 11 here next month, and happy campers, happy little family here in Tampa. What else? Snowfire says Vanguard loves me. Planning to open a 529 for the kids. Should I park in a money market or short-term treasury and wait for the next market downturn? Great question. Anastario, great question. Love that you're investing in that 529 account for your kids' education. So that's a whole nother topic though. But the idea here, that should I park that money in a money market or short-term treasury and wait for the next downturn, folks? I know we do a lot of like strategizing and, okay, is the market going to be up? Is it going to be down? All that kind of stuff. I always default though. I mean, that's just because we love talking about stocks and I love talking about where's the market's going and all that. But, if we get back to that core satellite approach, you are always invested. You are always invested 60, 70% in those funds and always have your money at work for you. You have always got those, 10, 15 stocks that you have working for you. You're never totally out of the market, right? Because we don't know if the market's going to go up or down any given month or year. Okay. But over the long term, you want to be in the market. Over the long term, stocks are going to go up and you just don't know when that's going to happen. You can kind of adjust tactically, maybe hold a little bit more cash, hold a little bit less cash, hold a little bit more bonds, hold a little bit more covered calls, just for that protection. But you never want to be totally out of the market, okay? Because I always default to a great quote by Peter Lynch. It says, more money has been lost waiting for a bear market than in the bear markets themselves. Okay, think about that. That's a great quote. Everybody likes to talk about, okay, our stock's going to fall. What should you do? All that. And people, people get this idea to, okay, you know what? I'm just going to go all cash, wait it out, and then I'm gonna make tons of money when the stock market falls. I'm going to get in on those lower prices. And then they have to wait, a year and a half for stocks to actually fall, and they lose out on so much time and so much money. More money has been lost waiting for a bear market than in the actual bear market itself. So, folks, never be totally one side or the other. Never be totally 100% in stocks. Never be totally 100% in cash or bonds. I guess you could be 100% in bonds if you just don't want the risk, if you want that fixed income, but never be totally in a money market waiting for a market downturn. Maybe have a little bit of money set aside just in case, so you can take advantage of that. But especially 529 plans, long term, 10, 15 years, you want that invested. You want that working for your kids so they can use it for their education. What else? It's been a tough couple of years. Learned a lot, newbies, a couple of grand. Dougie wants, it's only allowing me to purchase the gold membership. Then I try to purchase platinum, it's automatically going to gold and won't give me. Okay, I'll have to check. Dougie wants to know on that investment, only allowing a gold membership. It might be sold out of the platinum. I know the other one is sold out. The diamond tier is sold out. Platinum might be sold out by now, so it might be only gold available. Just pick up a gold. You can get multiple ones if you want, but just pick up one gold token there. It's going to give you access to that investor community, the perks. I'm going to make those perks available to everyone. Giving everyone the free courses, the discounts. I'm going to make sure that this is a good investment for you, as well as just welcome you into the investor community. I appreciate that. Okay, what else? All right, this is upwards of 2 hours in this live stream. I think this is my longest live stream yet, so I'm going to cut it off here. If I didn't get to your question, please ask it in the comments below. But love doing these live streams. I'm going to try doing a lot more of these live streams because I love this kind of connection that we get here in the community and the Bowtie Nation. So I'm going to be doing more of these in the future. Thank you for being a member, and again, check out that investor community through Gigastar there, and that offer is going to close in less than 12 hours. So you got to make sure that you get in it. $31 for a gold token gets you access to those investor access and perks, gets you that monthly income from the channel and part of the investor community. But it ends today, so go ahead and check that out with the link there in the chat or in the description below.